I'm here with Mark Ainsworth from Intuitive Wealth. Mark has been in the industry for many, many years and he has a wealth of experience, and I thought to bring him on so that it will be valuable for you. Thanks for joining me, Mark.
Oh, you're welcome, Navin. How are you today?
Very good, very good.
That's good.
Yeah, thought of having a quick discussion about financial planning as a whole. I know it's a deep subject, but especially on the in terms of the property investors who are working with us, I find that it's an area which they totally neglect on. I thought it would be really useful if you can educate them on the importance of financial planning and few aspects of it.
Sure.
As a property investor, Mark, what should they be looking at in terms of financial planning in a broad sense?
I always keeping the picture or keeping an eye on the big picture. So in other words, what are we trying to do? What's the aim of the investment property for number one? So what's the strategy for it? So whether you're developing or whether you're buying off the plan, whether you're buying long-term, short-term, are you buying for growth or are you buying for cash flow? So I have some people that invest in some regional areas where they're looking for lower capital growth, but it serves its purpose as a cash flow. Okay. So positive cash flow. So I think the most important thing is understanding, rather than falling in love with the property or the actual returns on the property, it's making sure that it fits with what your strategy might want to look like. Okay. So from a planning point of view, we're looking longer term. So I have some clients now that say to me, Mark, when I retire, I'd like to live half the time in Sydney and half the time in Melbourne. Well, what we might do is look at an investment property in Sydney now that eventually they can look to accommodate their needs longer term by being that property for retirement. So it's sort of having vision and keeping in mind what the property is intending to do for you in line with that plan.
Correct. In terms of most of them don't structure themselves as well. In terms of structuring, Mark, especially if you're going into a property development project, what would be the ideal structure for a property development project as well as someone who wants to have a portfolio of property investments?
Sure. So one of the main things we're looking at on a property development is the first thing I would be looking at is, again, tax structuring for the best effective arrangement of taxing, being able to finance it. So making sure the vehicle's right for the financing of how you're going to do that, particularly if something goes wrong and you need to extend finance terms or whatever. And thirdly, around asset protection. So building your wealth, where you might then go down the road of doing some development stuff, which does come with inherent risk. It comes with great upside as well, as we know, but there is some inherent risk that some things you can't control. So structuring is important from tax, financing and ability to finance it, and asset protection for your current portfolio. So you don't need to necessarily cross-collateralize properties, put other properties at risk, or indeed yourself.
Yeah, and put yourself at risk.
Yes, correct.
Yeah, in terms of so for a typical family who would like to invest in multiple property investment, having a trust or a family trust would be helpful.
Well, in some cases it can, yes, certainly. Again, there's a myriad of answers to this because it depends on the circumstances of that individual and that family. But I would always be looking to potentially separate the principal place of residence from the investment portfolios if we can. So we try not to cross-collateralize, which basically means we're going to give the lender all control of what we do. I think structuring property, especially multiple investments, it's really important for you to maintain control of, you might want to sell one property, take that equity and use it into a development site or another better opportunity or whatever you want to do. If all your properties are cross-collateralized because they're all under one entity or jointly owned or they're through one particular lender, then you might think there's 100 grand equity coming out of the sale of a property. The lender, particularly in these days, might determine, no, we would like to reduce your risk or our exposure, so therefore we're keeping that equity. So at settlement, you think you're getting a 100 grand check, and in fact they say, no, you can only have 20. So structuring it. So yes, certainly the other vehicle that we use for family trusts and unit trusts are where you might be doing a joint venture. So there might be 2 or 3 parties coming together to do a development. A unit trust with the units held by a family trust is a perfect vehicle to provide that level of comfort from each other and separation from assets.
Correct. Okay. And the other area which I want to touch upon was self-managed super fund. If you can briefly explain how this works for someone who really doesn't know anything about it, so that we can go deep if someone wants to.
Yeah, sure. Look, it's a as we've discussed before, Navin, it's a complicated field, but in short, super funds can borrow to buy property. If it's called commercial real property, it just means, for the sake of this discussion, commercial property, you can rent it from yourself. So you could own the hairdressing salon in your super fund and then pay rent to it. If it's residential property, it has to be at arm's length, so you can't ever use it at all. Even when you retire, you can't use it. The upside is you can buy property, particularly in this sort of market. It's a good option. You know, the alternative use of capital is always considered about what else are we going to do with that money. So when the markets are looking, the share markets are looking like they are, you can certainly buy property in super. And one of the major upsides that people look at is when you turn 65 and retire, there's no capital gains when you sell the property. So that's the main advantage. But it certainly can be done, and there's processes and systems in place to protect and ensure that if you use borrowings from the bank, that they can't access any of your other super fund assets. So you might have 100 grand in the share market, and you put $200,000 or $300,000 towards a property with some borrowing. If anything should go wrong, the banks can't get hold of that other superannuation investment. So there's good vehicles to protect everyone, but it does require a bit of rigor and sort of working out what it is. It's got to be the right sort of property. There are some limitations, but there's lots of good upside as well.
Yeah. So for example, you cannot use this with a off the plan property. It has to be.
No, you can. You can purchase off the plan. In fact, I've just done one, settles next week, where a guy bought a commercial factory off the plan and he intends to rent it for himself. There are risks that the risks that we would need to consider in that situation in superannuation is if something should happen between when you sign the contract and the property is finished, ready for settlement. And when I say something happens, more around finance. So if the banking sector should change its mind and decide not to lend to the self-managed super fund market, you could be caught in a situation where you can't fund it because you can't get finance. So that's more the commercial risk that we need to manage, and there's ways to manage that. But you know, you can certainly buy off the plan property in super.
Excellent. Extremely useful information. Hope that would be adding some value to you. Please feel free to contact Mark if you have any financial planning advice. You can see the contact information below, and feel free to contact me if you need any investment property inquiries at all.
Great.
Thanks for joining, Mark.
No worries, Navin. Have a great day.
You too.
Cheers.